Hello everybody, this is Frank Guida with A Better Way Financial, and I'm here to give you a market update and review, talk to you about why we're doing so well here at A Better Way Financial and why people's funds are really doing well here in comparison to what the tumultuous market is, what's going on in the tumultuous market. So let's take a look at that. Let's take a historical look at the markets. This is the market from 2000 all the way to 2022, and if you can see here, this is right around 2009. What's happened here is, during that period of time, we got pretty used to double-digit returns, but, that hasn't always been the case, and we really want to take a look of a longer look at the market to try to get a grasp on what type of average returns that we should be actually looking for when we're looking at the market. So if we take a look here, January 2000, the S&P 500 was at 1469. And here, January 2022, the S&P 500 was at 43.59. So if you take a look at that average, 5.67% per year. Now, that does not include dividends, so you can actually add maybe 1 to 2% to that. So when you're looking at what you're looking to get on an average from the market, in that 6 to 8% range type of return. So I also want to point out some phenomena here. If you were an investor during this period of time, or an investment advisor, you might be thinking that you're really good at what you do, But I'm here to say that, it was really the market. That's what the market was doing. So, when you look at the other parts of the market, let's look at this period of time right here. 2000, 2001, 2002, that was 3 negative years in a row for the market, where the market went down 50%. Then eventually the market came back. Then 2008 hit, and bang, the market went down another 50%. And then the market eventually came back. And what a lot of people don't know, an interesting phenomena, January 2000, the S&P 500 was at 1469. January 2013, 1469. That's 13 years, okay, with the S&P 500 essentially not having growth. So could you imagine if you retired right there in January of 2000, and this was your return, you could have a very difficult time during your retirement years. And that is the reason why we do the philosophy, or we invest the way we do here at A Better Way Financial. Anybody can do well during this period of time, but you need strategy to get through this type of period of time. So let's talk a little bit about that type of strategy. What you're trying to do is you're trying to use, you're trying to have something that you can protect your funds with. So when you're looking at, something without that risk and without that volatility, these are really the things that you're looking at: CDs, savings accounts, treasuries, fixed annuities, and fixed indexed annuities. Now we know these four here, they don't have much of a return right now. So we actually use things like fixed indexed annuities, which we're going to cover in a bit. And then we also, when we're trying to get greater returns, we're looking at tolerating risk, things like equities, stocks, and mutual funds, and real estate, and commodities, and bonds. And we're looking at how do we manage these things to mitigate the risk. Well, for the most part, what we use here to mitigate these risks here in the market money is computer algorithms and tactical management. So we're going to cover a little bit on that too. So let's look at these fixed indexed annuities. What are we trying to do with these fixed indexed annuities? What we're trying to do is average a very good rate of return without having market risk. So this is an actual comparison of an indexed annuity, fixed indexed annuity with American Equity that started back in 2006, and this is showing up to 2018. And we could see how when the markets went up, this red line is putting 100,000 into the stock market, the S&P 500, and the green line is putting 100,000 into that fixed indexed annuity. We can see how when the market went up, people who had money in the fixed indexed annuity also went up, but not quite as high. But when the market came crashing down, people in the fixed indexed annuity didn't lose any money. Then markets going up, people who had money in the fixed indexed annuity, their money was going up, but not quite the same trajectory, and so on and so forth. Right around here, they finished about the same. Okay, so that's not really a fair comparison because again, this did not include dividends. So, but if you look at fixed index annuities over time, they've tended to average in that 4 to 6% rate of return, which is a very reasonable rate of return for your safe money investments. So why do you want to have safe money investments? Because the market, if you have all your money in the market and the markets go bad, you can run out of money. I'm going to show you an example here of what we're talking about. This is a real life type of example because this is 2000 on forward, and these are the actual returns of the S&P 500 themselves. And what we're talking about here is $250,000 in the market, and what would happen in the market, and then taking out 5% of that, or $12,500 each year, and what would happen to the funds. And we're going to compare it to a fixed indexed annuity with a 50% participation rate in the S&P 500. And what that means is with the fixed index annuity, when the market goes up, the S&P 500, you get 50% of the gain. When the market goes down, you lose nothing. So here we can see in the market, $250,000 in 2000, the year 2000, well, the market went down 9.1%. Then if you took out 12,500, you're down to 214,000. Market went down 11.89. You took out 12.5, you're down to 176,000. Market went down 22%. You took out 12.5. Well, geez, 4 years into this thing, you've only got half of your money. You got $125,000. The market had a big old gain of 28%, and then you took out 12.5, and now you're up to 148,000. So if you continue this throughout the years, by the end of 2020, you have $70,000 left. With a fixed indexed annuity, we can see here, started with 250,000, market went down 9.1, but the fixed index annuity didn't go down because they don't. And you took out 12.5, so you're down to 237.5. Market went down 11.89, but your money here did not go down. You took out 12.5, you're down to 225,000. Market went down 22%. Again, you had no market loss on your fixed index annuity, but you took out 12.5, and now you have 212,000. And that year, the market went up 28%, but you only got credited 14%. But you got credited 14% on $212,000, not 28% on $125,000. So you did that. You took out your 12.5, and you continued to do this, and you can see at the end of 2020, you've got $233,000, or almost what you started with. So this is the reason that we look at safe money during the retirement year. And let's review here. Since 1929, the markets have gone down 20% or more, 15 times. That means on average, the market does this for about 7 years, an average of 7 years. Could be 5, could be 9, whatever. But for an average of 7 years, it goes up. Then for an average of 1.3 years, boom, goes down. That's historically what's happened. Then the cycle starts over again. Now, if you're in a buy and hold situation, during, you're young, let's say, your 30s, your 40s, your 50s, when you're still accumulating money, the market's going down really doesn't mean anything, as we can see historically, because they've always come back, But when you're in your retirement years, it can make a difference, because when the markets go down and then you take out money to live from your portfolio, that money's not going to grow back. As you can see, that's what happened here. So that's why we want to have safe money in our portfolio. What about our market money? How do we try to keep that safe? Well, one of the most popular strategies is the buy and hold strategy. And that, basically when you buy and you hold, and we said, that can work just fine during the accumulation years, but not so much in the retirement years where you can have a problem with it. Then there's that good old emotional investing, which is very popular because that's what people usually do. Everybody knows you should buy low and buy and sell high, but that doesn't seem to be what everyone does. What happens is when people start seeing their money dropping, their natural reaction is to want to get out. We're all human beings. We don't want to lose. So that's a lot of times what people do. And when they do that, it's really bad for them. I'll show you here. This is called the Dalbar study run from 1994 to 2013, showing how the average for the stock market was a little over 9% during that period of time, but the average stock fund investor only averaged a little over 5%. Why? Well, for that you look at the Investment Company Institute study, and what this study is showing is, this is the red line here is the market itself, and the blue line is people's buying patterns. What's wrong with that picture? People are buying and selling congruently with the market, when in essence they should be doing the exact opposite. They're reacting emotionally. Oh, the markets went up, I better get into the market. Oh, the markets are going down, I'm losing money, I better sell. Terrible way to do it, and that's why most people don't have good returns when they're emotional investing. So we talk about tactical management, and what tactical management does is it allows the algorithms, the computers, to invest your funds for you based on historical returns and based on what's happened in the past and different ways the markets have reacted. So when you have your tactical management, your algorithms, much of the time when the markets are going down, it's either pulling out of the markets or going into sectors of the markets that may have a good experience during the market itself. So it sort of mitigates that risk when the markets are going down. So we can see here one of our more popular models, the Sector 100. It's showing year-to-date on here. Year-to-date return, this was at the end of May, was minus 9.27%. Okay? So this was down 9.27%. At the same time, the stock market itself was down 12.75%. So almost 13%. But somebody who has a portfolio here at A Better Way Financial usually has about half of their funds in the fixed indexed annuity. So if you had half of your funds in a fixed indexed annuity and the market went down, how much did your money go down? Didn't go down at all, right? So half of your funds didn't go down, and if you had half of your funds in an algorithm like this that went down 9.27, that means that your total portfolio was down about 4.65% at a time when the S&P 500 was down 12.75%. This is what we're doing here at A Better Way Financial, and this is why how we're trying to help keep your money safe and have reasonably and good rates of return throughout your retirement. It's the reason that we are probably the fastest growing investment firm here in the Lehigh Valley. So I want to thank you all for listening. I want to invite all of our clients to come on in for a review, and all of our folks that are watching this that are not clients yet, you're welcome to come in and take a closer look and see what we can do for you.